from a drift yesterday down to the 50-hour moving average. Anyway, we'll come to the VIX in a minute and lots of other charts. So what a week. What a week. Have we reached an inflection point? Have we reached a tipping point with the Fed? Only time will tell, obviously, but very, very significant. Fed much more hawkish than the markets were expecting. We've got this anticipation now of the dot plot showing a rate rise for 2023. I think it was like 13 of the 18 members of the Fed, the FOMC, we're talking about their dot plots looking like a rate rise for 2023. And indeed, 7 of the 18 are looking at possibly a 2022 rate rise. That's very much ahead of what the market was really expecting for the June meeting. So certainly caught markets on the hop. We had a big lift, I'm sure you're all aware, in the dollar. So let's just have a look at dollar index. And it's, I should have brought this up beforehand. There's a dollar index. That's Dollar-CAD. It's not Dollar-CAD, but it's just as good an example of what's going on this week. Let me just get my charts in the right place. So, Euro. We were at 122 not so long ago. Here, beginning of June, we were up here at 122. We were testing 123. And we're down under 119 now. A big move. We're trading at 118. Where are we? 118.87. Let's zoom out. That's the weekly chart. There we go. So a big move down for euro dollar this week. Key yesterday, we went under that key 200-day moving average here on the daily chart, and we continued to move down. It was a key Fibonacci support level as well from this rally up we had in April, May, and our top there at end of May as we touched 122.50, and then we come down quite aggressively. So we went up, as is fairly typical with these waves in charts. We go up quite slowly and we retrace quite aggressively. So is this all waiting on the Fed? So is this a simple retrace of this big up move, or is this the up move now over the second 2 days this week? Wednesday and Thursday would suggest that is perhaps over as we're under the 200-day moving average, but certainly a big sharp decline in euro dollar. Emma, good morning or good afternoon, I don't know where you are in the world. Good evening, wherever you are. Anything you want to talk about, stick it in the box and we'll have a look at it together. But this is euro dollar on the 1 hour time, on the daily time frame. Let's just run through the main crosses. So you see this against all the dollar crosses this week. Big surprise from the Fed. Remember, markets hate surprises. We've had the Bank of Canada cutting, tapering in April. Ironically, the Fed haven't actually talked about, didn't use the T word, didn't talk about tapering, didn't talk about cutting the QE. And this has caused the reaction. So when they do perhaps start openly talking about tapering, we could see a very significant rally in the dollar. But at the moment, it's perhaps too early to tell. Markets tend, the other key thing as well, the other caveat is obviously markets overreact both to the upside and to the downside. So there's some argument they may have overreacted to the machinations of the Fed this week, but it's very, very significant moves. So that we'll see. Only time will tell, simply because of where the price action moves, and price action is telling us that has moved over and rolled over quite significantly. Vicky's asking about gold. So let's have a look at gold. Gold's on everybody's lips yesterday and over the last few days. Huge decline in gold as well. Some key technical levels we got to yesterday. I heard Andrea talking about it yesterday. That 1770 was a key Fibonacci level from the big rally we'd had. Where's my gold chart? In the... I can't find this. Bring in a new one, just as quick, probably. So let's just take this back to the daily time frame for gold. This level here, this 1770 level where we touched yesterday and bounced from it. It was a big, if we put our Fibonacci levels on, Well, I can find it. There it is. This double low here, we had it 1675. We went all the way up here. Actually, Andrew's already got this on here. And there's that 61.8 level around the 1770 level, which we crashed into this week. And as you can see, it's certainly shaken out. So if you're thinking that if you're a gold bull, it's retraced 61.8, the key Fibonacci level of that big rally up for April and May, but like we saw in the euro chart as the dollar strengthened. So we got a dollar strength and the safe haven or inflation hedge for gold disappearing as everybody's accepting that the central banks maybe, their mantra about inflation being transitory, it seems to be playing out. So we've had a weakness in gold, bid on the dollar. So this obviously the price of gold goes down because it's priced in dollars. So we've come down from the 1900 test all the way to 1775. And where do we go from here is the issue. Well, again, in simple moving average terms, we're under the 50-day moving average on Wednesday. We crashed under the 200-day moving average yesterday, and we got to it. Many would use as a target this 61.8 retrace level yesterday. So we've bounced off that. As I say, is it a retrace or is it a new leg lower? Well, again, as ever, time will tell. But lots of profit being bagged over the week on the short gold position there. Next leg down is the where we started from at 1675. So if we actually move, that's obviously a big old step from where we are now at 1770. It's a big step down that takes us down. The extension of that move down would take us all the way down here to 1545 zone. So again, only time will tell. But it's a very aggressive. As we saw in euro, it's quite an aggressive move to the downside. There, go on. There we go. To the downside, having moved up quite gradually. It looked like we were in this congestion zone at the top, this 1875 zone, and then we crashed right out of it. So I hope that's made sense to you. Vicky, you got whipped yesterday. Yes, it can be very volatile, the gold market. Be very careful. Tuesdays, and just in my analysis over the years, Tuesdays and Fridays in particular can be quite volatile for gold, but we've obviously had a Wednesday and Thursday volatility this week, so whether we're going to follow through today as well, again, only time will tell. It's very quiet today so far. Ninja's asking, what should we be looking at next week? Well, next week we're into the final full trading week of June, or there's 3 weeks of the following week before June wraps up, and we end remember, it's not just the end of the month in 10 days time, it's the end of the second quarter, it's the end of the first half of the year as well. Lots of some people say, well, it's just numbers, it's just days. But from lots of books' point of view, lots of trading positions' point of view, it's an accounting wrap-up level as well. So lots of books are balanced at this sort of time of the year for the next few days. So half of the year, end of the month, key in the next 10 days. As far as next week's concerned, Vicky, or Wise Ninja, I love your handle, my friend. It's Bank of England are very much in focus on Thursday, Super Thursday for Bank of England, the inflation report, the statement, the interest rate announcement. Won't be any interest rate statement change. However, Andrew Bailey's been on the stump quite 2 or 3 times this week, hasn't talked about, obviously, particularly monetary policy, but obviously the UK, it's still 6 months into its life after Brexit. Big issue with a rise in the Delta variant in the viruses in the UK this week. It's put back the final phase 4 opening of the UK economy, which is scheduled for the 21st of June, this Monday coming. It's been put back 4 weeks to the 19th of July. Bank of England got all of that to weigh up as well. We've seen spikes in inflation in the UK, just like we have in the rest of the world. So Bank of England is the key thing on Thursday. And the other key events next week are the PMIs. Remember, PMIs are forward-looking, both the services and the manufacturing PMIs for the UK, the EU, the US. They call them different names in different parts of the world, but basically you're looking at manufacturing and services PMIs, and the non-manufacturing PMIs is the other term the Americans call their Purchasing Managers Index. That's what PMI stands for. So they're the key economic events of the week. Obviously, this week we've had the tail end of the G7 summit over the weekend. We've had the big event of the first summit between President Biden and President Putin, a bit of a sideshow. Also this week we've had some positive spin around the Iranian and nuclear negotiations that came out this morning. We've got the Iranian presidency elections going on today. Very, very low turnout by all accounts, and quite strong not right-wingers, but hardliners on the stump in Iran. So it looks like that's becoming a bit more away from the moderate section in the Iranian economy, society. But things at play in the background as far as market sentiment is concerned. So less of that next week. It's really the economic data comes back to the fore, PMIs and the Bank of England. And obviously, the other key thing that's really underpinning things is the focus on the yield curve as far as the credit markets are concerned as well. We've had this squeeze. We've had this very narrowing of the difference between corporate debt and the long-term, very, very safe US government debt. And so the risk in the market seems to be coming back. So the rally we had in the NASDAQ yesterday may be something to start to follow through, but that will be countered by any strength in the US dollar. So as ever, it's always a balance. It's always a combination of things going on. So there we go. Why isn't it? Is economic good? That's why gold is cheaper. Maybe people calling crypto as a hedge more than gold. That story about the crypto's been a hedge to gold. It was very prevalent earlier in the year, in the first quarter, as cryptos rallied. Obviously, cryptos have rolled over very significantly and leading the way down to being Bitcoin. It's bounced back to about 40,000, I think, at the moment. But obviously, it's very volatile. It's very prone to personalities, as we've seen. Anything that Elon Musk, in particular, might tweet out, or anything that's what they call MicroStrategy, the guys that bought $1.5 billion of their big long-term bulls on the crypto market, particularly Bitcoin as well. So the volatility continues in that market. Noah is asking about a guppy. Guppy, what happened to the guppy yesterday? Well, no, the yen had a strong day yesterday. It's had a strong move overnight. Remember, the other key thing, the Bank of Japan's really got lost in all the furore around the Fed this week. But really, the Bank of Japan remained steady again this morning. They had their announcement. Mr. Kuroda's he's been on the stump today. No big change there. They're committed to this low, ultra accommodative policy in Japan. What we did see was a spike in inflation in Japan. And I don't think I hear myself saying that, but the core data in Japanese inflation on this morning actually went positive again for the first time in nearly 14 months. It was only 0.1 of 1%, but the core figure did move positively. So we saw a stronger yen overnight, and particularly yesterday. And again, where's my dollar yen gone here? Sorry, it was pound yen, wasn't it? Let's have a look. Let's just put it on here. It was pound. Let's do this. Is pound, Swissy was pound yen. There it is. There, I dragged that on there. There we go. This is pound yen on the daily time. So basically, no, it was a really big sell-off yesterday, but it'd been not necessarily been coming, but we'd been here. Let's just zoom this out a bit. So you see, we'd sort of been legging up, hadn't we? The highs had been getting higher, and we'd had this big candle here towards the end of May, and then we'd moved sideways. But generally, as you can see, we're sort of biased down. Those wicks to the north, let's zoom in a bit here. You can see these wicks here were generally tailing down. We had a one up day here at the beginning of the week, and then we started to trigger down. Now it was a big sell-off, so we moved down. We stopped at the edge of the Bollinger Band. The Bollinger Band is starting to widen now. Yesterday's candle was very significant because it broke below this support level here, and it kept going basically. So it started just above this channel here at 154. 60, we broke out of that, and then we moved down really aggressively on the close. So we were down into the close. We were supported by the 50-day moving average, but then today we've legged down again. So we're under now currently. Can't obviously on the end of day basis. No, you can't make a decision until today is over. But at the moment, it's looking quite weak, isn't it? You'd want if this break lower is going to continue, you'd obviously want this. The candle today to break and hold below the 50-day moving average there at 154.20, 153.20, I should say, sorry. Let's just put that in there. There, and that looks like that's moving lower if we close under 153.30 or 153.25. No, I don't know if you were, presumably you were long, were you, and got caught out, got stopped out, but, again, it's I say this all the time, lots of people say it's not just me, but size matters when it comes to candles. And look at the size of yesterday's candle compared to the last 10, 12 days, and it was negative, wasn't it? It was down, it was below. That had gone up, and then we retraced it. And the other key thing about this big Mizubu candle here, it's not strictly Mizubu, but it's a big, strong-bodied candle here, isn't it? This one here. If you're an end-of-day trader, there on the 27th of May, we retraced 50% of that rise up within 2 or 3 days, but then we just gone sideways, waiting. And the thing about trends and strategies and what have you, the longer we go sideways, the longer we're in a channel bound or range bound, the stronger the break from it can be. Just like it was when we were going up. So we went all the way back here to end of April, we went sideways for 6 days, then we legged up. We went sideways there for, so about 12 days, then we went up. Here we've gone sideways for even longer, and then we've moved down. And now we're down yesterday. We closed, where we were starting the rally up, or beginning of the rally, not the beginning of the rally, but that last leg up. And that's a key level. See how that 53.23, the level we talked about today, where our 50-day moving average is. If we look to the left, it's not just a coincidence, but we go all the way back here to the beginning of April, and that was a resistance level. So that resistance level here for this rise for February and March, which we couldn't break at the beginning of April, we did eventually, but it took to the middle of May, is now our resistance to going down, our support to going down, but we broke it without thinking this morning. We've gone through it. So if this continues down today, that's quite weak. And as you can see, the next big line in the sand is a 200-day moving average, all the way down there at 146.70, and the 100-day moving average is probably around there at the big psychological 150. So 152.75 is where it trades at the moment. 150 is the 100-day moving average, and 146.70 is around the 200-day moving average for pound yen. Need to get back over yesterday's open, back into that channel over 154.60 to go to the upside. Vicky, what fundamentals say about dollar after Powell speaks? Well, that was it really. The fundamentals. Powell testifies next week as well. Sorry, I didn't mention that today. He's got a key testimony to the Treasury Committee in the Senate next week. He'll be obviously quizzed and questioned about the last key meeting. As I said, they haven't actually said they're going to taper, they're going to cut or anything. It's just what the individual members of the Fed have put on their little bits of paper, their little dot plots. The key thing for me, as I said to the guys here in the office this morning, the key thing will be in 2 weeks' time when the minutes come out. What was actually said, what was documented, what was agreed, who agreed with it, who disagreed with it. Remember, there were 13 of them bringing their dot plots back into 2023 from 2024. So there's obviously been some quite interesting discussions. And my interpretation of it, for what it's worth, is that the Fed are perhaps taking the prospect or the spectre of inflation a bit more seriously than perhaps they're saying officially in public. The issue with inflation that has been proved over years and years and years and years and years is that it can be quite sticky when it comes back. Okay, the counter argument of that is that we haven't had any real inflation for many years. Certainly in the last 10, 15 years since the central banks have been in charge of the forex markets. But history shows that it can be quite sticky. But we have to go back quite a long way to the 70s certainly the 80s and the 70s for any sticky levels of inflation. So is that going to happen now? We don't know. What we have been in a global recession, but it was induced by an unknown that wasn't planned for. Nobody could expect it coming, and it appears that the economies, that certainly the developed market economies, are bouncing back quite aggressively, quite quickly, and perhaps even sharper than many people are saying. So 7% growth for the United States in 2021 is what the Fed also said on Wednesday. So see what Powell has to say on that. He testifies on Tuesday, I think it is, to the Senate. So watch that as well. Vicky, Name's asking about Sam from India. I want to know about your screen indicator. Do you mean what's on the charts? These are Bollinger Bands. The white lines are the Bollinger Bands. The blue line is the 50-day moving average. The red line down here is the 200-day moving average, or the 200-period moving average. This happens to be the daily chart. It happens to be the pound against the yen. The green dots are parabolic SARs. These are all just indicators on the chart. It's a bit cluttered. Below here, we've got the MACD. This is ATR. ATR is one of my favorite indicators. And the spiky one here is the stochastic, and the white line is the RSI. But, use indicators that work for you. You use a time frame that works for you. Join me on Tuesday when I'm going to do how to improve your trading mindset, because this business is all about psychology. It's all about understanding yourself. It's not being able to read these charts. Anybody can learn chart patterns and understand cables and patterns and candles and lines on charts and things. You've got to understand yourself first and foremost, and the best person in the world to do that is your mother. But if your mother's not going to trade for you, you've got to understand yourself first and foremost. Okay, so you can't get off first base if you don't understand yourself. So join me on Tuesday with more details on risk management and understanding yourself. Neem, my friend. Pound expected 140. Well, Wally, you might be right, my friend. Wally's here saying Guppy's expected to 150. Well, yeah, 150 is where the 100-day moving average is, as we've said. It's a big sell-off yesterday. The yen's getting a bit of a clearly bid. It's not just against the pound, but we'll see. Trade what you see, not what you think, my friends. Have a system, trade your system, accept your losers, bag your winners. Keep it simple. Please speak about in-screen and how to set it up. So, Neem, come to the webinars. I just want to talk on live charts at the moment. I'm not going to show you setting up charts and stuff, but we'll see if we run out of questions. I'll certainly have a look at it again. While he's saying, good support area for pound yen, it certainly is. Let me just have a look. I haven't got any questions from Facebook friends. Let me have a look. If there's anything there. No, I'm not going to see this. How do I see my Facebook questions? Paul's saying, will dollar index move to 93, says Raja. That's an interesting question, Raja. Dollar index, it could easily move to 93, but it could easily move to 90 as well. I know that sounds a bit flippant, but we've been testing 92 today. We've had a very strong rally, Raja, in the dollar index. Let me just pull up the dollar index chart. Here it is here. So yes, we've had a very, very strong rally this week. Obviously, again, just like we've seen with other dollar crosses, the dollar index itself very strong since Wednesday, Thursday through 90, and we're actually over 92 at the moment. So 93 isn't that far away as a stretch. But what we would see again, just like we looked at that extension on the gold, where was the top? Well, the top was 93.45, and that took us back towards the end of March. Right in the end of March, in fact, was our top for dollar index, 93.45. Remember, let's go back to the beginning of end of December. We here were, along with lots of other analysts around the world and brokers around the world, were writing their 2021 outlooks, and everybody was talking about a weak dollar for 2021. The charts certainly look like that. The markets certainly look like that. And what happened in the first quarter? The dollar kicked everybody's butt. The dollar rallied really strong. We had a very, very strong start to 2021 for the dollar. Dollar index went all the way up to 93. But since then, we've been down very significantly for April. We were down less so for May. We went all the way down. We went under 90. We tested 89.45. And then we went sideways, and we've started to show some signs of life in the dollar. And then we've had a big kick up the bum from the Fed on Wednesday, and we've moved back up. But it's a bit of a rounding bottom here, you could argue here. The second half of May and the first half of June, it looks a bit suspect, one would argue. So again, time will tell. But if you're a trend following, strategist or trader or whatever it is, you've had some big candles. First, it was last week. Obviously, we had this big breakout on Wednesday. We're now over the 200-day moving average for the first time in a long time, and we're now at 45-day highs. We're over 92. Let's see where Friday goes. So, Raj, potentially 93 is certainly on the cards. Why? Good afternoon, sir. Good afternoon, South Africa. You're approaching the beginning of winter, middle of winter. Hope you're well, staying well. Never really gets that cold down there, does it? It's a bit wet, doesn't it? But you've got your big car to keep you safe, haven't you? That's it. There's nobody else on Facebook, so let's go back to my friends on YouTube. What's that? I don't understand what that means. Don't enter now. Do the fire. I don't understand what that means. Do you speak to me or speak to somebody else? You must speak to me. Sir, if speak in Hindi, it's very easy. Name, I'm sorry, I don't speak Hindi. We've got some Hindi speakers here in the office, so they're the support team as well. So easy for you. I guess, Nima, you're talking to Hindi. All right. Espanol. My colleague in Mexico is our Spanish-speaking analyst, Control, and he's probably just getting out of bed, or he's probably in the shower still. But he'll be in the office in a minute. Wally, very nice. Thank you, my friend, for that. Right, let's have a look at what else is going on. So, if nobody's asking about anything in particular. So that was a pound, that was the guppy. We've looked at the dollar, most of the major dollar crosses. Dollar yen we didn't have a look at, but dollar yen, again, this is the 1 hour chart. Let's go to the daily chart and zoom that up a bit. There's lots of lines on here. So again, but as you can see here, nice blue channel here from the end of April. So at May, we've been ticking higher. We were rolling over 109. We rolled over 109. We rallied up to 110 at the beginning of June. Then we dipped down again. Looked like we were going low, but this time we held over 109.50. So the channel's held. We've dipped down. So we've just been oscillating, but now we've been oscillating in a rising channel. So we've been top and bottom. Now, currently, we topped out the top of the channel on Wednesday following that surprise move by the Fed. We've cooled yesterday based on the rally in the yen rather than the weakness in the dollar this pair. Remember when you're trading Forex, guys, or when you're trading anything, if you're trading gold, silver, whatever it is, you're trading against something else. So if you've got a strong side to the pair and a weak side to the pair, that's an easy pair to trade, isn't it? Because it's only going to go in one direction because you're trading the difference. Remember, that's what we're trading now. We were trading contracts for difference. And that's what we're looking at. We're looking at the difference between the two sides of the balance pair. When you've got two currencies or two things that are relatively strong, they're sort of cancelling each other out. And that's sort of what we've had with the dollar yen over the last couple of days, because we've had a big lift for the dollar, but then yesterday the yen got a big lift. So that's cancelled the big rise in the dollar yen on Wednesday down. But, we closed, interestingly, yesterday above where we started on Wednesday. So that's still relatively big. We're in the upper half of this channel. We're in the upper half of the Bollinger Band. So dollar yen still remains. Dollar seems to have the upper hand there. Technically, we need to our top. Looks like we're at 110. I'm sure where that line is. There, it's all a bit messy to solve. Replicate to use somebody else's chart. But we've got key support is the middle point of our channel here, which sits at 110.02. So above the big round psychological 110. That's obviously now the clear line in the sand this week. It's a bit early to say that is categorically the case, but hopefully you can see that if this indeed is the inflection point, if the Fed this week has been the tipping point, the inflection point, 110 now becomes a new line in the sand. For weeks we were talking about 109 for dollar yen. Now we're at 100 pips higher at 110. So let's see if that keeps going into the end of the quarter and into the full summer season. Remember, as we get into July and August as well, certainly in the the Western Hemisphere of the world. It's summertime. People might be trying to, economies are opening up continually, and the volumes start to dip. People start going on holiday, so things can do cool down over those summer months. But 110, big round number now for dollar yen traders. Aussie is David's asking. I was just going to come to David, dental spa supplies. So do you supply? I don't know. Supply teeth braces, David. What do you do? What's dental supplies do? What do you do? You provide that liquid that you drink when you're having a filling, that pink stuff. I remember years and years ago, the last filling I had, a long, long time ago. Anyway, Aussie dollar, David. Well, that's the 1 hour chart. Not surprisingly, we're down. We're down from 77. We're under 75, or we're testing 75 at the moment. That's a key psychological level for the Aussie. And again, just like most of the other dollar crosses, we're down for our 4th consecutive day down. Significantly at the moment here on this day chart, end of day chart, we tested the 200-day moving average yesterday, and today we're under it and moving lower. So that's, excuse me, so a quick sip of water. I don't know what time frame you're interested in, David, but as you can see here, let me just put this temple on. As you can see here, we were relatively sideways, relatively big, but sideways during May. June, first half of June, we were also sideways, sort of consolidating around this 77 level, and now we've moved down quite significantly on this announcement. Again, the data out of Australia, to be honest, has been relatively strong as well. So this is very much driven by a stronger dollar. We've had some good jobs numbers, in fact, blockbuster job numbers out of Australia. The caveat for the Australian economy continues to be two things. Really, they've dealt with the coronavirus differently to lots of other parts of the world. They're not looking to roll out vaccines very aggressively at all. So I think there's only about 5 or 6% of the Australian population vaccinated. But what they are doing, they're being very, very aggressive with their lockdowns. Melbourne, their second biggest city, a city of 4.5 million people, went into complete lockdown for 10 days. For initially, it was only 5 cases. The cases went to about 25, but there was still, even last week, the second week of the lockdown, there were still 2 cases, and they were still very much in lockdown. That's been relaxed this weekend, but different way of dealing with the pandemic. But as far as the economy is concerned in Australia, it's bounced back quite strongly. And the other key caveat has been this fallout they've had with the key export market of theirs, China. There's been some political conflict over things like wine and other exports to China, and there's no sort of clear resolution to that situation at the moment. Australia joined members of the G7 in their quite strong rhetoric against China last weekend. Anyway, as far as the Aussie is concerned, that's clearly broken out of that channel. We've moved down. We're under the 200-day moving average. That's negative. If we close under it today, that's significantly negative. The MACD here, as you can see, was really ambling about, not really much in direction, which you would expect because we've had no direction during most of May and the first half of June. But then we started to show weakness in June itself, the MACD, and it started to move down quite aggressively in the last few days. So that would have triggered as that's moved out of that channel. As far as this trending strategy is concerned, the last big move, but it would have been a weak entry because the moving average was still going sideways here. It was here on the 11th of June. The break was really the break below on Wednesday when we broke below the 76.55 low that we'd had at the beginning of June. So it took till Wednesday to confirm that break was happening. We followed through yesterday, and at the moment, I say we're below the 200-day moving average, so that continues to track lower. So the question is, where do we go from here? Well, let's have a look what the weekly chart tells us. Well, the weekly chart remains relatively sort of sideways consolidation action, but as you can see here, if we zoom this up, the Aussie now has the 50-week moving average there at 74.70. So 74.70 is the next key support. The parabolic SAR has flipped to the north this week because we had a big negative week thanks to the Fed. So first support, our first target moving down would be 74.77, and then the 200 period weekly moving average sits there at 73.30, and we were last under that key moving average all the way back there in October last year. So our Aussie looks like it's rolled over, and again, it's more to do with the dollar strength and that inflection from Wednesday for the Aussie pair. David, I hope that's answered your question. Let's just go back to Facebook and see if there's anybody here on Facebook. Let's quickly refresh this. Romeo saying, thanks for the heads up. Absolutely no problem, my friends. Stay safe, everyone. And if you get off the vaccine, I can't tell you what to do, but I'd take it. I've taken it. I've had it twice. I'm quite happy. But there we go. It's individual decisions, of course. Where are we? So that was the Aussie. Another one that's been interesting, Kiwi was weak today, and it's moved perhaps more aggressively than some of the others. The Kiwi dollar. This is the 1 hour time frame. See, that's very much down this week. Let's just put a little movers on. So this is the 1 hour chart on the Kiwi for this week. There we are, Monday. We're all the way up there at 71.50, and here we are. We're down at 69.60 at the moment. Very negative MACD from Wednesday. Again, see, you can tell there, can't you, clearly where when the Fed announced what they were doing. Huge candle as we dipped down, retraced a wee bit, and then we've been down, consolidated, then down again, and then down again now as we come into the open of the US market. Not a great deal of data out of the United States today. In fact, I'm not sure there's anything, to be honest, to get excited about today. Not really. I don't think there's a speech. I think there's one. What's the date? 18th, isn't it? No, nothing of significance. There's a Bank of Canada really this morning. So I'm just looking here. I'm on our traders tool, showing us that this pair here that we're looking at now, the Kiwi against the dollar. This is the dollar is the strongest of the 8 major currencies, and the Kiwi is the weakest of the 8 major currencies. At the moment, we're down 2 and a bit percent. Today, is that 24 hours? Yeah, in the last 24 hours. Yeah, that's quite a significant move. So that can't be last 24 hours. But anyway, as you can see, again, it doesn't really matter what percentage it is. As far as a trend following trade is concerned, he's certainly been short from that big shock on Wednesday. Retrace, but you're still short. You're trailing your stop down, and we're moving low. The low of today has already been put in at the moment at 69.47, but we trade at 69.61 at the moment. So we bounced a wee bit off that, but the trend remains very much to the downside. We're under the 20-hour moving average. It's all the way up there at 69.93, so below the big psychological .70 level for Kiwi traders, and that's trending really nicely to the downside. The other one I want to show you was CAD. CAD has been Dollar-CAD. If we've got the daily time frame, you see this big downtrend we've had during most of 2021. We were all the way up here at 130 close beginning of the year, and we just legged down and down and down. And then another one with this what looks like this rounding bottom. Ahead of the Fed on this week, but we moved all the way down under 120 at the beginning of June. We tested it in May as well. We sort of sideways, and again another one, big flat floor. Can you say that? If you've had a drink, difficult if you've had a drink to say that, isn't it? So there we are. 121.20 is the top of the channel for those second 2 weeks of May. The first 2 weeks of June. First sign of life was here for the CAD, Dollar-CAD. Was this candle here as we came out. Big candle again, size of the candle matters. Here on the 11th, this time last week. breaking out the channel. So, and then Wednesday we broke the 50-day moving average. Thursday we followed through, and today we trade at 123.85. So some significant pip movement this week again for Dollar-CAD, and lots of obviously dollar trades. Hope you've all been the right side of the move. Remember, certainly in the forex market, the central banks are the most important. The things they say, the things they don't say, their announcements about rates, their announcements about inflation and growth and expectation, all that sort of stuff is absolutely vital to any currency. The most important currency in the world remains the US dollar, so the most important central bank remains the Fed. And what we've had this week is the world's most important central bank saying something very significant that the market wasn't expecting on Wednesday, and we've had the reaction accordingly. So we've had follow through on Thursday, Friday. If it's going to continue into July and into the summer, again, only time will tell. But at the moment, the trend is very much to the upside. We had on this pair, for instance, we had a bit of an indication this time last week that something was up, because we'd broken above the channel. We'd closed higher than we had for weeks and days and days and days and days and days. And in fact, let's say days and days. Let's just do it. There we go. It was 22 days high we closed last Friday ahead of the Fed on the Wednesday. And this move down was as we've seen it all year, but it was exaggerated by the Bank of Canada moving earlier than any of the other central banks and cutting QE at the end of April. So that's helped this trend down. It's ran as far as it can. It ran to 120. It's at multi-year lows. Things only go so low for so long. Flat bottom for a long time, and then we started to move up. So let's see where we go from here. Obviously, the next big line in the sand for Dollar-CAD traders on an end-of-day basis is that 200-day moving average at 126.45, and the 100-day is probably around 125.20, halfway between where we are now to where we may be going. So Dollar-CAD on the up. Patricia, on Wednesday, if you were trading a US-based pair, would you have made a profit? That's one of those questions, Patricia. It depends. Patricia and everybody else, trading volatile events like the Fed is an art in itself. Personally, most traders tend to be out of the market for these big announcements, okay? Or they're hedged accordingly in case things go against them. But you wait till the noise dies down on an end-of-day basis. So if you were a strict end-of-day trader, for instance, you would, let's just go back to Wednesday then. Let's just use this as an example, this Dollar-CAD pair. You'd had your first suggestion of something was up on Friday last week, hadn't you? So you might have entered there because we'd broken out of this channel. You might have ended quite aggressively, to be honest, because it's a big candle and you've broken out of the channel. Anyway, that's besides the point, how much you've got in there. But that's quite a strong entry. The negative is that the MACD is still under the zero line. The signal line's rising, but it's under the zero line. We still haven't crossed it at this point on the end of day base, but it's relatively positive. You've got a big volatile event coming up, so just watch it. Went sideways Monday. We legged up on Tuesday, so ahead of the Fed. The dollar got another lift on this particular pair. Just literally reading the price action here of what's going on, where we finished on Tuesday. Again, if you were out in outer space or you're out in the wilderness and you didn't know the Fed was saying anything on Wednesday, and you came back from outer space or you got back from your wilderness track on Wednesday night and you looked at your charts again, you thought, oh, that's nice, isn't it? We've had a nice leg up on Friday. Monday, Tuesday went side. We had a nice leg up on Wednesday as well. I might buy that again because why would I buy it again? Well, I'm over the 200-day moving average. I'm at the top end of my Bollinger Band. I'm actually out of my Bollinger Band. That might put me off buying too much. But I'm over the 50-day moving average. When did I last do that? Well, I looked to the left and I was last over the 50-day moving average all the way back at the end of April. So that's another tick. That's another positive. Let's look at the size of the candle, Patricia, there. Yeah, big end of day basis. Yeah. I guess, Patricia, your point was not an end-of-day trader, but if you were trading intraday. If you're trading intraday, that's a very, very different matter. Let's go back to, say, the 1 hour time frame and zoom in. So what we saw earlier in the week and what we were saying, what everybody we would say, but everybody was saying in the market, they were basically waiting for the big announcement of the week, and that was the Fed. And as you can see clearly, what's happened here when you drill down to the 1 hour time frame, so you were waiting. So if you'd waited until the announcement was over and the hour candle was over, and you'd entered then, you would have thought, well, I've got in really high because all week we've been all the way down here, but I've bought this there at 122.65. All week it's been much lower than that, and I've bought really high. It's been low. I could have bought down here. I could have bought down here. I could have bought down here. Last Friday, I could have bought it down here at 120.80. But the follow through since then, Patricia, has been positive. So what I'm saying in a very, very rambling way is whatever system you have, whatever approach to trading you have, stick with it. Trade it, but be aware if you're trading intraday. Be aware of these big high impact events. So my old mantra I've had for years, Patricia, is have a system, trade your system, and accept that you lose a lot. Accept your winners, bag your winners, accept your losers, keep your losers small, and you live to fight another day. And it's all about discipline, patience, mindset, and managing your risk. Join me on Tuesday, Patricia, if you've not heard or watched the How to Improve Your Trading Mindset webinar before, because it really is all about risk management, my friend. If only I knew on Tuesday, Wise Ninja, if you only knew what the Fed was going to say. If that's your mindset, Wise Ninja, stop trading now because your mind is going to beat you ultimately. Go and do something else. If you can't accept losing, go and do something else because the market is ruthless. The market goes up, it goes down, it goes sideways. That's all it does. It does it, sometimes very, very quickly, sometimes very, very slowly, but that's all it does. And you've got to find a system, find a time frame that fits your lifestyle, fits your personality, and an asset that trades that fits your personality as well. Each asset has their own personality, and you'll find that some stocks, for instance, can tend to trend quite nicely. Forex tends to gap around a lot. It's very mean reverting. Within a day, it doesn't move very far. You don't see announcements that the dollar index has moved 17% today, but you can see announcements like AMC cinemas have moved 28% today. It's all about relative risk. It's all about understanding leverage, margin, all those sort of other good things that come into trading when you're trading CFDs. My friend, well, you're absolutely right. Absolutely, yes, indeed. Wise and Ninja. Nobody else on. Let me just refresh Facebook. I can't believe there's nobody else on there. Perhaps there isn't. Perhaps it's Friday. Perhaps everybody's gone off to start their weekend. Looks like it. Or nobody's got up. Okay, so where were we? That was CAD. Silver's been a big mover this week, along with gold. Significant mover. Where are we? So it's only 5:10. Let's have a look at the equity markets as well. So equity markets have been a bit mixed this week. We've had some interesting moves for the tech market, the NASDAQ 100, and some opposite moves in the Dow, the industrials, the USA 100. This is the most important one of all. This is the USA 500. It's 500 of the America's biggest companies, in fact, some of the world's biggest companies. It's a very broad-based stock index, and it is the most significant and most important stock market in the world. And again, a big psychological level is where we've got to with the USA 500. We punched out new all-time highs earlier in the week, this week at 4,266, but we're down now quite significantly, trying to hang on to 4,200. So again, if we zoom this one in, we can see we're generally moving higher, aren't we? The highs are getting higher, the lows are getting lower. Our 50-day moving average here on this big long-term chart going all the way back to September 2020 sits there at 4,160, but that's only 40 points away from that 4,200, which we're trying to hang on to at the moment. If we zoom in, we can see where we've rolled down to 4,200, and is that current. Let me check that's actually up to date. I'm not sure that's that today. Let me just refresh this template. Make sure we're talking about the right thing. Yeah, that's today, and yeah, we're down again today. So we were actually closed flat yesterday, up a tad, but we were down Wednesday. Why did the stock market go down when the dollar went up? Well, that's to do with relative risk. So as the dollar gets stronger, it makes it more expensive to buy US stocks, basically. So and it makes it more expensive for US exporters to export their goods. So 4,200 is the big line in the sand for the USA 500. Support is the bottom of the Bollinger Band there of 4,175, and then that 50-day moving average at 4,160. So two things could be going on here. Let's zoom up. Hang on a minute. There we go. We could be consolidating again here, like we had a bit of volatility there. We consolidated there, and then we moved up. We consolidated. We actually retraced here into at the beginning of March, but we've continued to move higher. So again, traditionally, July and August, traditionally notoriously relatively weak for equity markets. Volumes die down as people, I was saying earlier, in the West go off on holiday. There's less volumes in the market, but we still look relatively robust to me. The 20-day moving average, we're actually under currently. We're slipped into the under half of the Bollinger Band, but more importantly, we've flattened out. Looks like we're consolidating or we're flattening out. So this is either a consolidation here to go higher, or if we could take it back here, we could take it all the way back here to the middle of April. You could argue we haven't really breached much higher. We've had a bit of a hiccup here in the first half of May for 3 or 4 days, but we didn't really want to go low. We didn't want to go higher either. So we're really in this sort of channel here. If I just put on, if I insert a rectangle, you can see we're sort of in this sort of area there. That's really, a big significant breach of the 50-day moving average now, which has moved higher than it was when we tested it here in May, is key. So if we broke something there around about under that sort of level there, the 4,100 level, it could be and close down here somewhere. That could be a significant sell-off to come. However, it's far too early to tell. For me, that's still relatively robust. It's dip buying clearly going on. We'll see. Remember, as we move into July, so 3 weeks from now, we'll be looking at 3 weeks from now, we'll be looking at starting the second quarter earnings season. So again, equity markets will start to look forward to that 4-week window. And see if the second quarter has been as good as the first quarter was. If so, we could then have another leg higher from here. But certainly we're certainly more or less channel bound there on the equity markets. Oil is the other one I was going to look at, and then we're going to come. We started with VIX, so we're going to come back to the VIX. So the oil market here, you can see this is the monthly chart. You can see what a strong 2021 we've had. It's come down time. The weekly, very, very strong. 2021 again. Remember the hiatus. It was beyond. It was about this time last year, wasn't it? When that we went negative on the contract, the oil contract. But since then, big break, strong move. We're over 65. We're now over $70, $72 earlier in the week. And oil remains relatively robust as well. So this week we've topped at 72.50. In fact, we've gone higher than that. This contract is 72.80 on this particular chart. This must be the spot chart on the futures. Yeah, okay. So that's ticked a tad higher. But again, as you can see, big support at $69. The 200-day. The 20-day moving average, 50-day moving average, all the way down there at $66, and that's a strong uptrend. Just a caveat on today. Today, just everybody, it's the third Friday of June. What does that mean? Well, the third Friday of June, March, September, and December means it's quadruple witching. What does that mean? Well, it means there's potential lots of volatility, particularly in the stock and the index market. It's the futures, the futures and the options market, both their index futures and individual stock futures and options, all expire today on the third Friday of June. Next time it happens like this altogether is the third Friday of September. So maybe a bit of volatility, or there will be potentially quite a bit of volatility, certainly in the futures and the options market. That might filter through to the spot market and therefore filter through to the CFD market here on your MT4, MT5 platforms in the index and stock markets later on today when that happens later on, because it's official quadruple witching day today. So watch that later on potentially. Thanks. Was trading today but came out early morning. Okay, well, yeah. Well, again, Patricia, if you close your positions before the actions happen, that's all well and good. Come in. Hopefully you've been back in since then, Thursday and Friday, and caught the rally in the dollar since then. However, my friends who stayed in lost. Well, it's probably more to do with the volatility that was going on at the time of the announcement, because markets hate shocks, they hate surprises, and it was a surprise on Wednesday when the Fed announced that the statement said about the dot plots. Nothing changed as far as interest rates are concerned at the moment, but it's all to do with outlook. And the markets are always looking forward. They're always looking 18 months, a year, 18 months, if not 2 years, and a bit ahead all the time. So expectations were there weren't going to be any rate rises until 2024. They're surprised with the story of 2023 and the amount of people that were ticking those boxes. Remember, it was 13 of the 18 people in the committee. Not all of those people were voters. Only 9 of them vote, but obviously the voting members have more significance than the non-voting members. But certainly 13 out of 18 is a majority in anybody terms, isn't it? So 2/4 of 1% rate rise is expected by the members of the Fed for 2023. So there we go. Yeah, that's that volatility. So just, Patricia, you probably did the right thing by coming out, closing your positions, waiting to see till everything cools. Some people like to stay in. They like the volatility, those big moves. They see candles moving very aggressively and things like NFP and central bank announcements. But it can be very volatile. It can be very risky. So you've got to trade a strategy, a system, a style that fits you. There's no point trying to compete with yourself when you're trying to compete with the market as well. So find something that fits with your personality, fits with your approach to life in general. Don't try and fit your personality to the markets, because that never works. So, the very best of luck to everybody. But find something that works for you. People spend a lifetime not getting there. Others find it straight away. It's very much an intuitive thing. It's very much something for you to get right. We're here to help, obviously. Technical analysis, fundamental analysis, sentimental analysis, all key to market moves. But principally, as I said before, it's a mindset business. It's a psychological business. It's greed and risk and reward and all those other things, and managing your emotions. Where do we get to? We've done commodities. We've done markets. Let's have a look at where's the Nasdaq? I was going to VIX. We start with the VIX. Let's have a look at the VIX. The VIX, remember, guys, is the volatility index. Okay, often known as a fear index. We got let me just take this to the daily time frame, and we've been drifting low. So again, you can trade this like you could trade anything else. But what the VIX is principally is like an insurance policy. So as the VIX goes up, as the volatility increases, the fear rises, equity markets tend to go down. And as equity markets go up, the volatility goes down, the fear goes down, we get into a complacent mode. So we'd been down here, we'd got as low as 16 just earlier this week, in fact. All the way down here, there we go, 16 here. And as the contracts started to roll over, the people are prepared to pay more to be insured. They're getting a bit worried about what's going on. The The market had already gapped on Wednesday. Look at this. This is the Wednesday gap. So Tuesday and Monday and Friday last week, we were down here testing 16. And then here on Wednesday, this might have been, again, your first heads up of things might have, people in the know might have known something was coming from the Fed, perhaps. Who knows? But we had a big gap on Wednesday to the upside. So we went from 16 to 20. It doesn't sound a lot, but 16 to 20, that's a 4-point move. If we're at 60, that's a 25% rally. The VIX can move around an awful lot. There's lots of potential moves in the VIX by its very nature. It can be quite volatile. So we've gapped up to 20 and we're currently moving higher. So as the equity market we just saw with the USA 500 starts to move lower, the VIX will move higher. So the VIX is over 20. It's a key level again. So that's suggesting market participants are prepared to pay more to insure their portfolios. That's how lots of players use the VIX because obviously they can't get in and out of their stock positions like individual retail traders can. They have to be in the market. They're in for longer term, so their portfolios are built and yes, they trim them here and there, but they never sell a whole chunk of positions all at once. So they hedge their positions if they think it's going to be a bit volatile, going to move down a wee bit. We're taking some call options on the VIX, so that they benefit from the VIX going up as their actual main portfolio loses value going down. So they still end up not too badly off in the case. So as far as the VIX is concerned, we're over the 50-day moving average, which again is significant at 1968, and the 200-day moving average sits there at 2211, so another 20% from where we are at the moment. So big week for the VIX as well, interestingly, ahead of the Fed. So bear that in mind, perhaps, guys, next time. Always worth having a look at what the VIX is doing. So if there's no more questions, I'm going to wrap it up before the US Open. In fact, let's just hang around for the cash market on the US, see what's happening with the cash open. Nobody else on Facebook for some reason. No, nobody else on Facebook. Let's just hang around till the cash market opens for this final trading session of a very, very interesting week. Remember, next week, if you're just joining us, top of the shop next week is three key things next week. We've got the Bank of England on Thursday with Super Thursday. Perhaps, obviously, Bank of England not a significant player as the Fed were this Wednesday, but certainly significant for sterling traders and euro pound traders or anybody trading UK companies. Also, all week we've got the PMI data. We've got manufacturing and services PMI data from the UK, from Europe, from Australia, from China, from the United States. So the major industrialized countries all publishing their PMI data. Why is PMI data important? I hear you cry, or perhaps you don't, but basically PMI data is forward-looking. It stands for the Purchasing Managers Index. So it's what these guys in companies are looking to purchase so they can make stuff if they're manufacturers, or they can service stuff if they're service companies like accountants and bankers and doctors and lawyers and all those sort of good things. So key indicator of what's going on. Remember, 50, anything in the PMI index over 50 is an expansion of that particular sector. Anything under 50 is a contraction. We've seen generally in the developed world now we're over 50, we're into 57, 60 for some of these numbers out of the United States as well last month. So they come out every month, manufacturing and services and non-manufacturing, they call it in the United States as well. So check those numbers next week. And the other key event is Chair Powell has got a major testimony to the US Senate on, I think it's Tuesday as well. So they're really the three key things I'm looking for next week. Remember, the other key thing about next week is it's the final full trading week of June. Some positions for some players will be getting tied up and getting balanced for the end of June, which is also, remember, the end of the quarter and also the end of the half year. It's probably a bit premature to be doing it next week, but some will be, because the following week, we've still got 3 trading days of June left, Monday, Tuesday, Wednesday. The following week for June itself is wrapped up and the line is drawn under the first half of 2021 already as another 6 months gone. It looks like stocks are opening down. We've still got 5 minutes or 3 or 4 minutes to the opening bell. But if we go back to the equity markets, I think futures, we're down here. This is the USA 500, the hourly chart. Is our channel we put on before. Remember, we're down here at 4189, so we're 11 points under that key, 4,200. The USA 30, the industrial complex, is also a very similar 4-candle pattern down there. And again, another one's been under its 20. Look at that, it's interesting, under its 20-hour moving average. Let's put the days on there. See that we've been under the 20-hour since the announcement from the Fed on Wednesday. It was Wednesday, Thursday, Friday. We're down again, so we're at lows of the week, significant lows of the week at 33,470. So we're under 33,500 for the Dow. And the NASDAQ, have I got the NASDAQ on here? I can't see it at the moment, but let's have a look. Where's the NASDAQ? Let's do it. Let's go click. NASDAQ, similar for less so. Because we had a strong close yesterday for the NASDAQ. More on that in a minute if anybody's interested. But again, moved down. 50-hour moving average is the 1 hour time frame for the NASDAQ. The 200-hour is all the way down there at 13,975. The 50-hour is what we're testing now at 14,098. So big, round, fat, psychological 14,000 will be our line in the sand today. We breached it yesterday. Are we going to close under it for the close of the week today? But if we look at the daily time frame, again, that's relatively robust. The 20-day moving average for the NASDAQ is all the way down there at 13,386. All-time highs again yesterday. We've done that earlier in the week. We then retraced Tuesday, Wednesday. Big candle, positive candle, engulfing candle pattern. Look at that on Thursday. Big, strong candle yesterday. Bit of a retrace today, but NASDAQ, the tech stocks, back certainly in favour a bit yesterday. And it was a lot of it's to do with this idea that there's two arguments about whether the dollar's going to strengthen from here or it's going to continue to weaken for the rest of the year. And then the argument about inflation sits in that. And the yield argument sits on tech stocks. Tech stocks are particularly vulnerable to rate rises because they're not. A lot of them are not speculative. A lot of them are not making significant profits. So any increase in interest rates impacts them more than cyclical and financial stocks. So they've been hit a wee bit, but as you can see here. We've had a strong second half of May. We've had a strong June so far for the NASDAQ. All-time high just yesterday again. Retraced a wee bit today. So 14,000, a key, big, round psychological number. And obviously that was a previous all-time high here as we were rallying in April. We couldn't get over 14,000 for any length of time. Dipped down, but now we're back moving up. And we've retraced really all of that dip. That leg down here we had. Again, that's a little bit of a Fibonacci finesse there. That move down there we had in the beginning of May. We're struggling to break over it. Okay, we're struggling to move over that new high. We did yesterday. We've come back down again, but if we can either consolidate here at 14,000, move back down under the 20-day moving average, under the 50-day average, and suggest we're going to move down. Or we consolidate here, and certainly the next real level, if there's a clean break of this 100 level, could easily move to the technicians would say the next level is really that 161 technical extension of this fib level, which would take us to 14,800, 14,780 for the sake of round numbers. But we may just be struggling to do that. And we're not going to reject this level. We can't move down. We can't break away from it at the moment. So we need to break away from this 14,000 level, and then we could quite quickly run to 14,800. If not, we move back down to the 20-day there at 13,800, and the 50 there at 13,650. So that's the NASDAQ for you. Markets have just opened. We're down generally across the board. Adobe, interestingly, I saw a note earlier. Adobe's one of the biggest moves. Adobe's up 2.5%. 13 Wall Street analysts earlier today upgraded Adobe. The most ambitious was, I think it was Goldman Sachs. They've got a new target of $665 for Adobe. Citibank were the weakest. There was, I can't remember the exact number. It was 5 something, but 558. Sorry, 585. They actually closed at 551 yesterday. So strong upgrade for Adobe from the Wall Street analysts this morning. We got some movement in the tech stocks here. Tech stocks are all down. JP Morgan and the banks are down as well. JP Morgan's down 1.7% on open. Bank of America was down 1.76%. The tech stocks less so. So the financials are getting a bit of a whack here at the beginning of the final trading session of this week. So unless there's any more questions, ladies and gentlemen, I'm going to call it a day. Have a safe weekend, everyone. Stay safe. Keep your loved ones close. And we'll see you all again next week. Remember, PMIs, Bank of England, and the testimony from Mr. Powell on Tuesday. Stay safe, everyone, and we'll see you all again next week. All the best, everyone. Bye-bye.